So here's the 3 ways to show proof of income if you're self-employed, if you want to buy a mortgage in today's market. All right, so before we dive in the video, if you've never met me, if you've never seen me before, my name is Kenny Simpson. I'm a mortgage broker by choice. Thanks for stopping by, checking out the channel. I've helped over 5,000 clients, funded $1 billion of loans, and here to help you. So if I can help you, let me know. But also keep in mind that, look, I help a lot of self-employed borrowers, and I'm going to go through the 3 common ways that self-employed borrowers show proof of income in today's market to qualify for a mortgage. So let's just go over the quick one that is the most common one. Is number 1 is tax returns. Yes, you are going to show your personal, your business tax returns. And what does that look like? So let's go through it. Number 1, if you're going to use your tax returns, we could ask for 1 year, 2 year. It just depends. If you're going to do a Fannie or Freddie Mac loan, a conventional, you can actually qualify on 1 year personal and business tax returns if you file both. Kenny, how do we do that? Well, number 1, we got to get the AUS. That's the automated system to allow us to use 1 year tax return. And most likely to get that, we are going to need to show that you've been self-employed for at least a minimum of 5 years. So let's go into second part of this. So let's say you do file a corp. You have an S corp, right? And you pay yourself maybe a W-2 out of that, and you have money that flows from your K1 into that, so we can use it. What can we add back with the S corp? Depreciation, amortization. Sometimes we can add back one-time expenses. Maybe you went out and bought 10 vehicles and wrote them all off. Maybe we can add that back in. So there is sometimes common sense underwriting. It will just be what at that particular time, that year, what you have. But that is one common thing. So tax returns, business, personal, there's option number 1. Option number 2 is one of the second most common, is a bank statement loan. There's 12 months or 24 months. Let me explain this. If we're doing a business bank statement loan, we're typically going to use, right off the bat, if it's business, we will take your gross income on your deposits. So we're going to look at all deposits. And look, we're looking for deposits that actually are in your business. So if you got money from weird sources or things like that, or a one-time big income coming in, we'd have to source it. We'd have to talk about it. But let's just say you're a business owner and you have $50,000 a month of gross income coming in, and you have expenses. We'll just take 50. We'll whack you 50%. We'll take 25,000, and that's what we'll use for income to qualify you for a home purchase, right? That is the next option, is a bank statement loan. We could take 12 or 24 months, depending on what you want to do, and that is typically how we do it. If you want to use more than 50%, we would need to get a CPA to write a letter and say, wait a second here, Mary and Joe, their business is only a 20% expense, a 30% expense, a 40% expense, and we can ease up on the hit on expenses. Also, in regards to bank statements, we can also use a combination. If you have 2 businesses, we can use both of them. Some of them we can actually use a business, and we can use a personal account because you might have money coming in personally. Also, stay on that. Let's say the husband's self-employed and the wife's W-2, and we need to use both income. We can actually use wife's W-2, husband's self-employed, bank statement income. We can actually use both to qualify for a mortgage. And just so you know, I'm doing one right now as I shoot this video. And option number 3, which is one of the least common, but we can do it out there, is a P&L. So if your CPA or another CPA, you can send them your financials, you can send them your stuff. They will draft up a P&L. So it's a profit and loss statement with income minus expenses. And here's the net income. We can do that for 12 or 24 month P&L. Yes, you still have to verify assets if you're buying a house and all that stuff and have certain credit. But with that income, you can definitely qualify using the P&L program. Are there other programs that some maybe self-employed people use or buy or do things? Sure, but I went over the 3 most common self-employed options out there that we see most common here at the Simpson team that we're funding and helping out clients with. If you have any questions, let me know. Those can be done for primary, second home, investment property, also for purchase and refinance. And so if you have any questions with that, reach out to me, let me know, because we're able to help a lot of people. And those are the breakdowns of each ones. I will do more videos to break down each one about how we break down tax returns for self-employed, how we break down the bank statements for self-employed, and also how we break down doing a P&L. But I wanted to give you a general idea of the 3 most common the ways that clients are showing proof of income if they're self-employed and buying and refinancing home in today's market. But if you guys want to chat, if you guys want to reach out, if you guys have any questions, give me a comment below, hit me up. Jump on a call, text me, email me. Would love to connect with you, help you out. Love to look at your scenario. And one last piece of advice before I let you go that you really want to know. This is a big, big thing that can help you. Let's say you are the full doc guy and you want to buy a home in the near future, 3 months, 6 months, and you're not sure if you qualify and you have not filed your 2023 tax returns. The best thing you could do is get with somebody like me, send me 21, 22, and 23 returns and draft. I can look them over to make sure you can qualify for that purchase or the refinance. So I do that a lot. I look over tax returns just to make sure, hey, what's this expense? What's that? Is there anything else a CPA can do here to move things around? Or let me go talk to an underwriter to see if we can add back this one-time expense, or we can talk about that. So looking at your tax returns ahead of time, being proactive to know that you're going to purchase or refinance a property, I would always highly recommend. If you are active and you're looking to buy, get with a lender, get with the loan officer, get with a mortgage broker like myself, send those tax returns in, let us review. So that way you could be off by $5,000 or $10,000 or $20,000 just to qualify for the house you want to buy. Thanks so much. Talk to you guys soon.